Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. There's a shift happening among equity investors at the moment. According to share trading platform Stake, more people are moving from active to passive investing, or at least including index funds in their portfolios. Let's take a look at what else investors are buying, both here and in the US, and what trends we might expect from the next 12 months. Remember, this is general information only, and you should seek professional advice before making investment decisions. Matthew Leibowitz is the co-founder and CEO of Stake, which is a great supporter of this podcast. Matt, welcome back to Fear and Greed.
Cheers, Sean. Thanks for having me.
Passive investing, that sort of surprises me, to be honest, at the moment.
Yeah, I think so. But look, I guess what happens over the last sort of 2 years with the markets, I think people have become engaged with it and now are sort of seeing that it's not always a bull market. So you've got to sort of adjust your strategy, and people are starting to do that. I think there's always people out there that are sort of picking the eyes out of particular stocks, but there's also a bit of a movement more towards sort of recurring investments and just keeping a very simple strategy that sort of rides the roller coaster a little bit more smoothly.
Okay, so when we talk about passive and active investing, we're talking about sticking to a benchmark. It might be the S&P 200 or top 20 stocks, and that's kind of what you're buying. Active is more kind of trying to beat the market, shall we say. That's in very layman's terms, Matt. Is it because there's this uncertainty around the place at the moment that many investors are thinking, let's just do what the market does?
Yeah, I don't really know. I mean, everyone's really different and everyone's got their own strategies as to what they do. I think, what we've seen, at least in Australia particularly, is the fact that property is so hard to reach. Equities have become a new platform for people to grow their wealth. And it can get, there's a lot of stocks to pick, and you've got 2,500 names in Australia. You've got, the 6 to 15,000 in the US if you go all the way down the OTC chain. So it can get pretty difficult. So people just try to keep it simple, and a recurring, simple way to, stay in the market, stay invested, and treat it like a savings plan has become pretty popular.
Okay, so in terms of how people are engaging with the market at the moment, given the turmoil we've seen, certainly in 2022, and then it bounced earlier in the year, then it's come back a bit, are people more or less engaged than normal, would you say, at the moment?
Yeah, I think people are, I think obviously we had a real big spike during COVID. I don't think we're going to see that sort of level of engagement again, just because people are sort of back at work and back living their lives outside their own four walls at home. But people are still naturally engaged. I think that was a bit of a watershed moment for self-directed investors, that you can do it yourself, it is accessible, and that there are a lot of people out there that manage their own money ultimately. So we're still seeing at Stake levels of engagement that are higher, and people's strategies are shifting. And obviously with interest rates moving a bit, people's appetite to invest changes a little bit, and how they invest has changed. But people still want to be in the market. They're still really hungry for information. And you've always got people that, really like stock picking. That's something they enjoy. They like doing the analysis. There are other people that, as we've spoken about, want to invest more passively. Some people invest passively in stocks they know. They choose, an Amazon, a Tesla, or a Facebook, or something they understand, and just want to be in the market. So people are still going to invest. I think that's a thematic we're going to see continue, whereas COVID was sort of a thing that sort of pushed people over the line and showed them how to do it.
Okay, so let's talk about some specific stocks that people are trading at. We talk plenty about artificial intelligence on Fear and Greed. Nvidia, of course, is the chip maker, which has high-end chips, which are often used in AI mechanics. Nvidia, it's the fifth largest stock on Wall Street. They're not quite the household name of Alphabet and Apple and Microsoft. Are people buying Nvidia?
Yeah, it's been a major pickup across the AI names and the chip companies. They've also been playing that thematic through some of the ETFs. You can actually buy ETFs on semiconductors, for example.
Right. Yeah.
There's an ETF, I think it's called BOTZ, BOTZ, as well, which has a really big increase. And I think it's up like 42% in 6 months. So names like Nvidia, Microsoft's also been on a bit of a tear, and people sort of understand those companies. Nvidia's, I guess, I wouldn't call it, I don't know if it's safe or not. That's for individual investors to make up, but it's a very large cap company that's been around for a while, and it gives you exposure to something that you may want to be part of. So that and Microsoft have been the sort of two names that people have really gone to. And if they want the leverage exposure, they'll go to the ETF.
Okay. And what about locally? Are there any stocks here riding that AI wave?
I think WiseTech's probably the one. Really, it's been a name on the ASX for a while that's sort of been an attractive tech name. And that's up 125% over a year. That's the biggest beneficiary, really. I don't really know the ins and outs of that business, so I can't comment, but it's been the one that seems to be attractive to investors that want that exposure.
I did notice Appen the other day talking about potentially riding the AI wave. And Appen, the way I think about Appen is they human test all the stuff that eventually is done mechanically. Is that a fair description of Appen? I'm not sure that's a fair description of Appen or not, but they're certainly talking up AI.
Yeah, I think that probably suits their agenda. If you actually look at the stock, it hasn't really moved much in the last year. So maybe they're trying to move into that space. Investors haven't bought into it necessarily. Like, it's had a bit of a run over the last few months, but given a bit back. But I don't think it's the name that people rush to in Australia for AI exposure. It may just be a strategic thing they're looking at doing.
Stay with me, Matt. We'll be back in a minute. I'm speaking to Matt Leibowitz, co-founder and chief executive officer of Stake. Okay, what about the banks? I mean, the big four here and Macquarie are such major parts of our index. Are they popular in Australia at the moment?
Yeah, I think what you saw, if you actually look at tech, it actually started coming off about 2 years ago, 24 months ago. So what's been happening is people actually starting to look for yield and a little bit more safety, and banks pay a dividend. Obviously, when rates move, banks are actually generally in a better position, except obviously in the US with credit exposure. But Australian banks have got, it seems to be reasonable credit exposure. I think bigger and boring is more beautiful sometimes when the market gets tough. Yeah. And that seems to be a thematic, and people want the yield. It's like they want the fixed income in a way. They want to know that they're getting a regular return on their investment, and the banks offer that. So there's obviously been a bit of a rush to safety to some extent, and the Aussie banks are well capitalised. They've been around for a long time, and people see them as a safer bet.
Do Australian investors invest in US banks?
I think a few do. Obviously you had the Silicon Valley Bank situation, and then all the sort of provincial and smaller regional banks that had all sorts of issues. So there was a little bit of activity then, but we haven't sort of seen the same run to banks. You can get similar exposure in Australia unless you really want to make them a more volatile play in the US. So I don't think there's any major demand for US banks from Australian investors. If they're going to invest overseas, it's going to be in names and exposure they can't normally get access to here in Australia.
Okay, so presumably Tesla's one of those guys?
Yeah, Tesla's always a popular name, although it's drifted back a little bit. I think the Twitter Elon Musk situation has sort of taken a little bit of shine off it, plus the stock price has moved the other way. I think it's moving more into that artificial intelligence we spoke about before, that sort of exposure. Even some boring names that have really done really well. As I said before, that boring is beautiful again. Like the auto retailers like O'Reilly's and AutoZone, like they're up 50% the last year. Boring, steady, low growth, but well-run businesses have sort of been where the money's been moving to. People just have got, I want exposure to good quality companies. I don't need the massive growth that we saw in 19 and 20.
Right. Okay, what about the battery metal stocks and the lithium companies in those? We talk lots about them and you hear lots about them. Are they popular among investors?
Yeah, there's sort of two schools there. There's the investors and the traders. With a brokerage platform, you see a bit of everything. Those are the ones that move the most. They can move pretty sharply. Australian, miners offer some great access to lithium explorers or producers. So we see a lot of that. You've obviously got Pilbara, Sayona, and Lake and Core Lithium. In one time is GRE Green Tech, which is, I think it's up maybe 200-300% in the last week, which has seen a sort of rush of trading as well. That's GRE is the stock code. So there's always something moving in the Aussie market. You've got some, I think it's that before that moved, it had a $4 million market cap. I think it's at like a 20 now today. That's GRE. So a lot of interest in some of the small caps that offer really big exposure, but that's more for the traders and the investors. But people may see a long-term horizon for those and may say, actually, this is still a good entry point, and put it in my, in the back pocket for the next couple of years and see what happens.
So, Matthew Leibowitz, co-founder and CEO of Stake, what is the next big trend? Do you think that AI, a simple question, do you think AI will still some way to play out? What do you think?
Yeah, I don't really know enough, and I don't have a crystal ball, nor would I ever want to speculate as to what's going to happen. I think, look, these things, we saw it with marijuana stocks way back when we first started Stake. They were the hot thing, and they sort of went nowhere. This stuff there's always going to be one or two winners from each category. It obviously depends on the industry, but, AI is, I use ChatGPT. It's absolutely very powerful, and where that goes, it's pretty scary. Is it the next thing? I don't know. I think, is it already here? Maybe. I can't really answer that. Lithium, I think, driving electric cars around, and you see I was just in the US and I saw some of that, just how big it is over there, that it really is the future of automotive and travel. So, look, you've got to think there's still something there. But as I said, I don't know where the future goes. How much is it already priced in is another thing. You can be right on the thematic, you can be wrong on the price. So, each company is different, how well it's run, where its strategy is, where you buy it, where you sell it. That's going to make the biggest difference to your portfolio rather than actually guessing the theme right.
And just before we finish up, what about just taking a step back, the macroeconomic outlook, interest rates? Is that still something that people are worried about or investors are worried about?
Yeah, I mean, I think you can't run away from it here in Australia with the way that we're structured, with people's mortgages, the way it's played out with, there's the whole fixed to variable that's sort of playing out over the next couple of years. So people are nervous. We generally hear that. We've actually seen that a lot in terms of the exposure people want, how much they're investing and what they're investing in. They're sort of battening down their hatches a bit. But, the S&P is still up, I think, around 10% for the year. It's funny how the market is always ahead of the next move. As I said, 2 years ago, tech stocks really started to come off, maybe a little bit less than 2 years ago. So the market's generally ahead of the sentiment. So what's that great Buffett saying? It's be fearful when others are greedy and greedy when others are fearful. I think that's a bit of a moment now to consider that.
I've got to ask you, Matt, how is Stake going? We spoke, I think it was a couple of years, 2021, I think, when we last spoke. How is Stake going?
Yeah, it's great. I mean, it's obviously a journey, building any business, and a lot of respect to any entrepreneurs or people that run their own businesses out there. It's not a straightforward, thing to do, but absolutely loving it. We've just really focused on our customers. I think the last 2 years have showed us how much demand there is for people to directly invest or invest directly in the market, and that's who we serve. So we're just sticking at it, and we're really happy with where things are at, and a lot more to come.
Matt, thank you for talking to Fear and Greed.
Cheers. Thanks for having me.
That was Matthew Leibowitz, co-founder and CEO of Stake, which of course is a great supporter of this podcast. This is the Fear and Greed Daily Interview. Remember, you should get professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.